stock, okay? So you teach in business school about diversified portfolios and managing your risk and holding the market portfolio and combining it in a risk-efficient way with bonds and stocks. And the question honestly that I got asked the most by my clients was, what do you think of the price of Apple? Okay, and if it wasn't Apple, it was Facebook or Google or Amazon or Netflix. And actually in the last 6 months or a year, the focus shifted slightly. It became, what's going on in China? Should I be buying Baidu or Tencent or Alibaba? So I had to become very expert in all of these stocks, which was quite interesting. So the point is, there is an incredible amount of fascination with single stock stories and single bond stories, right? There is room for that. Your private clients, or indeed your people you're advising on their pensions or whatever, will be very upset if you don't have a very good story to tell about the underlying securities. But as we all know, the single stock selection is actually, in a way, less important than getting the tactical and the strategic asset allocation right. Which asset classes you want to be in, how you want to weight them, are probably bigger decisions than, is Apple going to go up or down, or is Facebook going to go up or down? You may have noticed that Warren Buffett, by the way, who's a great investor, and I urge all of you who are interested in investment to read his investment letters, has just increased his purchase of Apple stock, even though it's at an all-time high. Because he said, and it goes something like this, he said, it's no point obsessing about iPhone sales in every quarter. You're missing the point about this great stock, okay? Warren Buffett is, as you know, one of the world's most famous active investors. So if he's investing in Apple, you probably should sit up and take notice. Okay, let's talk a bit about the global distribution of wealth. If you think that the objective of wealth management is to advise individuals on efficient approaches to the market, which we think it is, yeah, you want to go out there and advise people on how to optimize their intertemporal decisions, get them the best return for the risk that they're taking, make sure that they don't run out of money in retirement, that they're adequately prepared for life's emergencies, that they've got insurance, all of these things. But if you want to do that, then you should probably set up a wealth management business or go and look for a job in wealth management in a market where this stuff is important, right? Where it's a big deal. And the data show that there is quite an interesting amount of comparative survey data. Look, a lot of this is sort of obvious. We know where the rich countries are and where the rich people are, but there is some interesting theoretical work on this. And those of you that are interested in sort of the theoretical modeling of the global distribution of wealth, right? You can look at this very good article in the Economic Journal in 2010, which found that wealth is indeed distributed extremely unequally, both across countries and within countries. Now, if it is unequally distributed, you're trying to set up a business in this area, you want to go to where the wealth is, right? Show me the money, as some of you will know from that movie. They also find, and we touched on this last week, that portfolios, how people actually hold their wealth, is extremely different across countries, right? In theory, people should have similar preferences, and they should respond to different assets in the same way. It should actually be pretty similar, but there are massive inter-country differences in composition, as we also talked about last week, right? Remember that the amount of, for example, the sort of fact about this that you should know in your head is that in the US, the proportion of stock ownership is very high. In Germany, it's relatively low, right? There are interesting comparisons like that. House ownership in this country is incredibly high. In Germany, again, I think it's a lot lower than it is here, right? Significant inter-country differences. So if you're planning a global strategy on this, you need to know about this. It also turns out that there is something called home bias that exists a lot, right? Home bias is a useful word to know about. What do you think that might be? What do you think home bias might be in an asset allocation context? Correct, and therefore denominated in their own currency, right? Which may not be a very good idea. Sometimes it's a very good idea, but it may not be a good idea. We discover a lot of home bias, and that's a bit of a pity, right? Because the explosion in the international markets means that you really should be looking internationally. If you're sitting in London and you only invest in, British Petroleum, which is not really a British company, but it's got British in its name, you're missing out, right? Even in the oil sector, you're missing out because you could be looking at, Amoco or, some U.S. company, or, if the Saudi government ever lists its oil asset, it could be, you could be invested in that. The point is, one very good thing that you can do if you're ever advising an investor, be it an endowment, a foundation, an individual, is, look outside your own shores. UK investors are heavily concentrated in the FTSE, and you really need to open them out to the fact that there is a big world out there. Even a little bit of international diversification can be a very good thing, right? And in particular, investing in places like emerging markets, if you can find a good, well-governed emerging market with a high rate of return, is usually a very good thing for your portfolio because it gives you a diversified source of return, okay? Now, in the simple version of the life cycle model, they come up with this model that says wealth is a function of labor income growth and population growth. You can go through the model in your own time. It's all pretty obvious stuff, and it seems to hold up pretty well if you look at international distributions of wealth, right? So North America accounts for about 30% of global wealth, but it has only about 5% of the global population. Europe has got about a tenth of the world's population, but only about a third of the wealth. I think this is just mainland Europe. And then obviously there are these massively fast-growing countries in Asia, with several Middle Eastern countries now also becoming extremely, well, they've been wealthy for a long time, but it continues as the oil price stays high. So significant concentrations of wealth in those areas. And of course, the underperformers in this regard are India and China, which, even though they have over a third of the overall population in the world, only have 4% and 10% of the global wealth respectively. However, China, as you know, is growing at around 7%. India's aspiration is to grow between 8 and 10%. So you would think that the amount of wealth in these countries would increase significantly over time. And in fact, most wealth managers have got a targeted China strategy. India is more difficult because the local competitors are very powerful, so global wealth managers find it difficult to penetrate that market. But certainly in China, there has been some significant foreign penetration, particularly based out of Hong Kong, although even there it's becoming a bit difficult given regulations on what you can do with your money if you become very rich in China. Okay, so, if you're a wealth manager, you probably want to be based in either North America, Europe, or the rich Asia-Pacific countries. It's not an accident that when I was working in private banking, that typically the offices are located in New York, London, maybe a Swiss presence for historical reasons, because Switzerland was an attractive place to do it. But that's where people were based. Hong Kong and Ireland are two interesting examples. They're not very, per capita income is not especially high, or it may be changing in Hong Kong, but there is a lot of wealth there. Hong Kong, it's obvious, a lot of it's coming from China. Why do you think Ireland has got such a lot of wealth concentrated in Ireland? Yep.
Tax reasons?
Yeah, tax reasons, very good. We talked about tax before. So Ireland has got a very favorable corporate tax regime. It attracts companies to come and live there. If you own one of the companies that are based there, you get a lot of benefit if you're based there. Ireland, quite an interesting market for wealth. And the Nordic countries are very rich in per capita income, but wealth is not very highly concentrated. Why do you think that is? In Norway, Sweden, Denmark, Finland, Iceland even. Yep, I think it was Benjamin Franklin who said that the only two inevitable things in life were death and taxes. Taxes account for a lot of differences. So, as a matter of social policy, Nordic countries wanted to have a very equal distribution of wealth, and as such, they achieved that by taxing the hell out of you if you earned a lot of money. There were still some fortunes that accumulated, but it was by very careful investment and by trying to stay out of the income tax net by taking a lot of your gains in capital gains tax. In capital gains, I think that has something to do with the fact that, for example, the Wallenbergs in Sweden have got a massive foundation, great industrial holding empire. Obviously, they became very rich, and there are many examples in other countries as well. But generally, the distribution of wealth in Nordic countries is very equal. So look, this is where the action is. The most recent example of a massive proliferation in wealth is Silicon Valley, obviously, all of the Google and Facebook and other billionaires. Switzerland, for, again, tax reasons, people have migrated to Switzerland because it's a good place to keep your money free and private. That's changing. Governments of the world are becoming very focused, as the UK was, as I mentioned earlier in the course, about where this money is coming from. London's a very big center. Dubai, obviously, for historical, and everybody's in London. And Dubai is emerging as a very significant financial center in the Middle East because a lot of Middle East money is being managed now out of Dubai. In fact, you'll find that most global wealth managers, and if you're thinking about careers, these are the places where you might end up working, right? Silicon Valley, less so. It's not so much a wealth market. It's just an incredibly vibrant technology market. But certainly for money management, it's London, Switzerland, Dubai, Singapore, and Hong Kong. In global asset management, interestingly enough, places like Edinburgh and Boston are very big for historical reasons. Boston is obviously the headquarters of Fidelity, and Edinburgh has got very many historical names in the asset management business. So what's going to happen in the future? Well, the good news, if you're a wealth manager, is that there is plenty of wealth concentration out there, right? Obviously, if you're charging, and many wealth managers and financial advisors will charge as a percentage of assets, you want to be where the wealth is. And there is plenty of wealth concentration out there. And it is quite plausible that financial services targeting the world's wealthy will continue to grow, and that financial institutions will want to target the market. I can't think of a single global big financial institution, not one, that hasn't got either a plan or a current presence in wealth or asset management. So even if you think about, if I asked you to name an investment bank, which one would you name? Name an investment bank, somebody. Association test. JP Morgan, another one? Another one? Yeah, another one? Every single one has got a wealth management and asset management business. In fact, Credit Suisse has said that they're going to go away from, and UBS, that they're going to step away from investment banking and focus on asset management and wealth management. So this is an attractive business. It turns out that helping people make efficient intertemporal asset allocation decisions is a profitable business, right? And by giving advice in that area, it's a very desirable income stream. People think, and this is open to debate, that relative to investment banking revenues, it is a more stable income stream, that there is more of an annuity-like character to a wealth management fee. So if you've got a client, you've got 100 million, if you're very lucky as a private banker with you, say you're earning, let's be generous, and say you're earning 1% on it per annum, that's $1 million with very little capital employed. The client's giving you their money, you're advising them on it, you reconstruct the portfolio periodically, you give them an extremely high level of service, but that's a very stable income base, right? And that's why banks find this part of the business extremely attractive. Now, that in turn leads to its own pressures because you're getting a lot of entrants now coming into the marketplace. And it turns out that the barriers to entry are very low, right? What do you need to be a wealth manager? What do you need? Supposing one of you guys wanted to start out. You do. That's a good barrier to entry, actually. That's a very good barrier to entry. Track record is a barrier to entry. Brand is a barrier to entry. Not everybody can be Goldman Sachs tomorrow, right? It takes 100 years to build up a reputation. But actually, the fundamental business of sitting in front of a client, looking at their portfolio, being relatively systematic about it, thinking about risk and return and their objectives, I'm sorry to say, but it's not rocket science, right? There's a lot of common sense. There's a lot of, you need to know the theory. You need to know asset allocation. But it's not that hard to do an adequate job. And so this has meant that there has been a massive proliferation of entrants into this business. So the big guys, the big banks that you all mentioned and you all know, have got very significant wealth management businesses. But there is actually nothing to stop one of you, ladies or gentlemen, going out there, getting some funding, set up a nice office in a good place where private clients might want to come and visit, and put a thing up on the door that says Imperial Wealth Advisors, right? Or Masters in Finance Wealth Advisors. And you know what? subject to the necessary regulations and you being fit and proper people, you're in business, right? The barriers to entry in this business are genuinely very low. If you're lucky enough to know 7 billionaires, then you can be in business tomorrow, right? Go to each one of them and say, by the way, guys, I'd like to help you manage your assets. I'll charge you a small fee. This is my office. This is my partner. We're both masters graduates from Imperial. We want to get going. And you're in business. Barriers to entry are very low. Staying in business is a different matter. There's reputational risk. You've got to do your job. If you do a bad job, you get sued by the client or the regulator shuts you down. You've got to be extremely careful. It's other people's money. You've got to act like a fiduciary, right? It's not your money. You must manage it in a careful and sensible way. But barriers to entry are low. Sorry, you had a question.
No, I was just saying that getting the client is hardest than getting
Yeah.
managing portfolio.
Yeah. You're right. That's an interesting insight. Getting the clients is harder than managing portfolios. How many people agree with that? Okay. How many people think that managing portfolios is harder than getting clients? Okay, interesting.
It depends on your confidence, I guess. There is pressure.
Yeah. Yeah. I think they're both very hard, actually. I think they're both incredibly difficult. I think getting clients through the door, signing up is very hard. And once you have them, sometimes winning a mandate is the easy part relative to the difficulty of actually keeping the client. Because, look, you're a private client, right? You read the newspaper, and I'll tell you what my clients used to do to me. You read the newspaper and you see that, I'm picking an example here, that Facebook is up 20% yesterday, or Apple is up 10%. The first call you get from your client, and you might have told them about efficient asset allocation and diversification, but the first call you get from your client is, how much do I have in Facebook or Apple or the stock that went up, right? I was managing a country portfolio once, a multi-country portfolio, and it was currency diversified, but just purely fixed income. And every month, the client used to call us up. It was an Italian client. Every month, they used to call us up and say, hey, I see that the Jordanian currency is up 30%. Why aren't you in Jordan? So there is a real tendency to be looking backward and to forget about the principles, right? When you're running a wealth management business. Okay, I've talked a bit about some of the challenges that wealth management faces. There is the entry, regulation, taxation. Governments are very keen to get their hands on wealth, so it's an asset that is under threat. But one book that maybe gives some hope to those in the wealth management industry is a book by a fellow called Thomas Piketty, who is a French economist who wrote a massive magisterial book called Capital. And it's quite interesting that it's called Capital because there is another very famous book with capital in its title. Who knows what that is? That was written a couple of centuries ago. Yeah, I heard somebody say it. Karl Marx, right? Das Kapital, which was the basis of the underlying underpinnings of communism and socialism. Anyway, Thomas Piketty, very ambitious young French economist, wrote this book called Capital. I would urge you to at least dip into it because it's got some interesting, especially those of you that are interested in international wealth distribution. But he had one very fundamental insight, which was the following, right? And the fundamental insight was this is the rate of return on invested capital, and this is the rate of growth of the economy, right? And his fundamental insight, which is a blindingly simple insight actually, is that if the rate of return on invested assets is greater than the rate of growth of the economy, which is sort of a plausible assumption in a way, because the stock market, because of the fact that you use leverage and you earn an equity risk premium, probably grows more than the overall growth of the economy, right? And if that is the case, then if you own assets, you're going to grow more than somebody who's just growing at the rate of the economy. Therefore, inequality will continually increase. Therefore, wealth managers should be happy, right? Because the rich people will get richer. Obviously, this is a problem for public policy because fiscal policy will act to try and reverse some of that. But the general insight here was that if the rate of growth of assets tends to grow grow faster than the rate of growth of income, then the people who own the assets are going to grow their wealth more than somebody whose income is growing at the rate of growth of the economy, which is G. And of course, as I said, policy then becomes quite focused on reducing these inequalities. Governments tend not to like that. Plus, it's always better to tax the rich people because they have more money. So that imposes some challenges as well. But the point here is that there is maybe a fundamental tendency, actually, for wealth inequality, if you leave the economy to itself, to grow over time. Right? Many people are very relaxed about that and think that's a good thing, that it maintains the right incentives for everybody to work hard, kind of the American model. But European governments think that maybe we need to tone this down a bit and improve distributions of income. Obviously, as a businessman or woman thinking about where to invest and grow your strategy, you need to think about these issues, right? Okay. Inequality is an extremig big focus of policy. Not strictly relevant to your day-to-day or indeed to your course in finance, but this can have big implications on how you think about a wealth management strategy, right? So a couple of years ago, in the UK, there were two things that happened. But obviously, Brexit was a big one, right? As a policy change that has a big impact on wealth management in the UK. What's happened after Brexit to people who have wealth management business or asset management business or indeed investment banking businesses in the UK? What's happened to them? What are they thinking about? What is the big strategic question on everybody's mind after Brexit? Yeah, moving, right? People are wondering whether London is actually viable as a centre. Anybody know what RND stands for? Anybody know what an RND stands for? Anybody who's interviewing for a job in wealth management should know what an RND is, or working in one. Yeah, very good. Who said that? Excellent, very good. So a resident non-dom is a term of art in the UK. It's a legal term, actually. And it means that if you're non-domiciled here, the shortcut means that if you're not originally in the last 100 years or so from the UK, and I'm mangling the legal definition horribly, so don't rely on me. Go and look it up in a textbook, or actually consult a lawyer, because it's very difficult to pin down somebody's domicile. But it turned out that in the UK, if you were not from here, you only paid tax on income that you brought or enjoyed in this country, right? Think about that. Everything else was tax-free. So you're an offshore person, overseas person. Maybe you are Indian origin like me, or Irish, or Chinese, or something, and you've lived here for a long time. And you have a substantial overseas fortune. And you don't pay tax because it's sitting in Dubai or Monaco or Switzerland. And you only pay tax on the money that you invest in this country. Great deal, right? Amazingly attractive deal. Which is why London, for many generations, has been such a magnet for the international wealthy, because you can live here and enjoy all the benefits of living in this economy. Schools, law, London. But actually only pay tax on the money that you bring into this country. And there was a whole industry that grew up around planning for these people, right? And guess what? The government figured out that they had a valuable source of potential tax revenue, so they essentially shut it down. It's still pretty attractive. In fact, if you come here and as a new entrant from a foreign country, you can enjoy full res non-dom benefits for 7 years, right? So if you come from, another country, you want to live in the UK, you can do this. You can park all of your assets offshore somewhere, live in London, and only pay tax on the money that comes into this country. That used to be kind of permanent. Then they started cutting back on it. And they created something called the deemed domicile rule, which meant that after 17 years, I think it is, you were deemed domicile, so you were just like a UK person after that. You didn't get any benefit. And then after about year 7, you start paying more and more tax until you get to year 17, and it tails off completely. The point here is that that change has had a very dramatic impact on the desire of wealthy people to live in London. I've seen a lot of migration in my client base to places like Singapore and Dubai, which have more attractive tax regimes. So it became significantly less attractive. Having said that, it's now gone back to being more comparable with international jurisdictions. Many places have worldwide income taxation. The US, for example, if you're a US citizen, you pay tax on your worldwide income. And there are other places that will not easily allow you to shelter your income from taxes. But the point behind my discussion is, these policy changes can have a big impact on a particular wealth management strategy. If you'd set up a big office in London 5 years ago to target res non-doms, you're sort of in trouble. If you'd set up a big French-speaking business to target the some 400,000 French nationals who live and work in London, and then Brexit happens, right? You got a problem. So you need to be aware of changes in the policy regime before you expand in a particular place. Hong Kong and China, very interesting case in point. I think the Chinese government is sort of tolerating what goes on in Hong Kong and encouraging it, but it's always a bit vulnerable to what the Chinese government decide about how much private banking can go on in China. And in particular, one very big source of concern is foreign bankers flying into a particular jurisdiction and offering services from another country, right? This is a big deal. And you can imagine why it might be, right? So if I'm an entrepreneur, this is a true example. I'm an entrepreneurial banker in New York. I need to build a book of business, to go back to your point about how hard it is to get a client. I'm an entrepreneurial banker in New York. I happen to be from Taiwan. I have a very rich uncle who lives in Taipei, and I know he's got lots of money. So I fly off to Taipei and I say, hey, uncle, can you please deposit some money in my bank in New York? Bad idea. It's against the Taiwanese regulations. It's not against the US regulations, interestingly. You can bank anybody in New York. But by flying into Taiwan and trying to do private banking business, which is a very highly regulated business, the guy got into a lot of trouble. And governments will sometimes just tighten it up, right? So they'll say you cannot fly in anymore. The Middle East used to be a reasonably permissive destination. So me as a banker sitting in London, I could fly to Dubai, Bahrain, go and prospect clients, no problem. But now they've got pretty focused on this. They don't want you to fly in, offer financial services, sell a product, and then leave. Part of the reason is that they want to regulate that activity, right? These are clients with money. You don't want unscrupulous people from other countries. They worry about that. And generally, because private clients always feel that they can complain to the regulator if something goes wrong with their money, right? And they do complain. And the regulator finds it very difficult to do anything about it if the banker is sitting in another country. So that's the reason that regulations on private banking are becoming very critical. That's why those of you that do go into private banking will have to be regulated to practice in the country in which you're offering advice. And if you're not authorized to offer advice in a particular country, it's very difficult to run a business on that. Okay, I've talked a lot. Any questions or comments on any of that? I'm going to spend a few minutes on talking about managing concentrated wealth, maybe 10 or 15, and then I'll give you guys a break. Yeah, any questions or comments? Very good question. Very good question. It would be substantially different, right? Because it's a client's initiative. They've come in to do it. However, I'm glad you brought up the question because there have been very important changes in the way that business gets conducted, right? In the old days, if you turned up literally with a suitcase of cash in Geneva, right? Not to pick on Geneva, you could do this in many other centers. There was literally no problem. You opened up a bank account and you had the ability to use those funds anywhere in the world free of question or challenge, right? You can imagine why this became a big problem for the governments of the world. They were leaking tax revenue. Some of that money was criminal. It was generally considered to be a very bad thing. They have significantly tightened this up by introducing something called Common Reporting Standards. Those of you that are interested, go look it up. What this means is that if you turned up to my office in London and said, I'm from Taipei and I'd like to open a bank account with you, I would ask you for your taxpayer identification number. Every country has one, right? Something that establishes your credentials for the tax authorities. And the moment that I see that you have a TIN, a tax identification from another country, it is now the responsibility of a bank in a foreign jurisdiction to report that to your home authorities. So if you thought that